I'm going to begin today with a story. One day, a very successful business owner had a meeting with his financial services professional, and they were going over different products, financial products, strategies, solutions in order to maximize his present situation in terms of his wealth and also legacy planning. And what came up during this presentation was whole life insurance. Now, the point of the sale and what this individual was interested in was not a life insurance death benefit. It was purely the cash value. The financial services professional begins to share the benefits of the life insurance policy. Did you know, Mr. Business Owner, that many people view whole life insurance as a death benefit product, but we also have the cash value, which is a safe area to position money. It's liquid, you can access the money, and then it is tax-free. You've got a guaranteed rate, you've got dividends, the wealthy have used this forever. And the business owner goes on to say, tell me more. I'm very interested in this product. So they go through the product. Eventually it gets to the time where he looks at an illustration. The financial services individual presents that to the business owner, and the business owner looks at that illustration, which has him paying in $100,000 per year, and just looks at it and goes, why would I do this? This does not look like cash value life insurance. This looks like trash value life insurance. I didn't come up with that saying on my own. One of my employees here came up with that saying. But the point is, he looks at it and he's heard all of these good things, that wealthy individuals do it, the tax benefits, and he pays in $100,000 and there's next to nothing there in cash value. Or it takes him 7 to 10 years just to get his money back. And he says, there are other things I can do with my money. The financial services professional goes on to say, you don't understand the benefits. You're missing the big picture. You can access your money through loans. You continue to keep your money at work for you. The business owner says, I don't think you understand. I am not taking this kind of hit on my money. This product's not for me. This story is something so many people go through in one way or another. They are either exposed to cash value life insurance and they decide not to move forward with it, or they do move forward with it and they question their decision and even have buyer's remorse and decide to get out of the product later. Why is this? Well, there is a big challenge in this industry. The challenge with whole life insurance is often we are told about all the benefits. We're attracted to the cash value, being a safe, liquid, tax-free area to position money. I hear good things about it. Rich people, the ultra wealthy use it. Big corporations use it. But then I've heard of so many people being taken advantage of and losing tons of money. I'm very afraid that that might happen to me, whether I'm considering positioning $10,000 per year or $1 million per year. Whatever the dollar amount is, I want to make sure that it is set up right. So often, we're presented an illustration where, okay, it's finally time to see the numbers. And we just look at it and say, what? Why? Why would I do this? What am I missing here? There has to be something, because I know the wealthy are smart with their money. They're not going to take a big hit on their funds. I look at the product. It comes off as expensive, pays very high commissions to the agent, and it will if it's set up improperly. Very low cash values, especially in the beginning. And it's confusing. When I'm asked to explain it to my financial advisor, my estate planner, mentors of mine, I can't do it because it doesn't make sense. These are just a few challenges that so often pop up with whole life insurance. But then, value, humongous value exists with this product. The thing is, it's not transparent. There's so much confusion, so much misinformation out there. How do I make it right? Let's look at some statistics, some data here. If you look at all of the major banks in the United States, one of the number one assets, their number one tier one assets, is cash value life insurance. Take Bank of America, for example. They have over $21 billion sitting in the cash value holdings alone of their life insurance policies. The majority of the banks in the US have this product. We've had the privilege, I have personally had the privilege of working with banks, one in particular in recent years, the past 12 to 18 months, in setting up 2 bank-owned life insurance products. They love the product and position as much money as they possibly can here based on banks' limitations. Wealthy families have heavily used these products forever. High cash value life insurance, specifically whole life insurance. What's interesting, this statistic up here, you can actually Google search this. And banks, by the way, you can look that up on the FDIC website. But when we look at wealthy individuals, a 2014 CNN article published this as a policy was purchased by a billionaire in 2014. He purchased a $200 million whole life insurance policy. Now, the saying in the article was, the wealthiest of the wealthy buy life insurance for many reasons, but one of those primary reasons is being the tax advantages. To simplify those tax advantages, it works very similar to that of a Roth IRA. Any money I pay into the policy, I fund with after-tax dollars, meaning I cannot deduct it, but that grows tax-free and I can access it tax-free as long as I don't trigger a taxable event. And we have other content on that. But this is used by the wealthy mainly for the tax advantages, and there are other benefits as well. The best tax attorneys and estate planners in the world recommend this product to their clients. And many times they are not even compensated. They are making these recommendations based on the best interest of their clients. We work with, in my opinion, one of the best attorneys in the country. She works globally, actually, and she is a huge fan of cash value life insurance. And she receives no compensation off of recommendations for her clients to purchase this product. There's something to be said about that, copying or learning from what wealthy individuals are doing. So questions that often come up with this, here's two common questions. One, is it only for rich people? Do I have to have a $100,000 annual payment to go into a product at a minimum? No, I can pay $100K per year in, I can pay $10,000 per year, it can be a few $100s per month. But then two, if I pay a lower amount in, can I have what the rich have? These rich people that put tons of money into products, can I have what they have? And the answer is yes, but again, it must be transparent. And this is the case if you are putting a ton of money in or if you're putting a small amount of money in. It's all relative based on one's financial situation. So, what to look for if you are considering a policy? What do you look for in order to make sure it is set up properly? Again, assuming that your point of interest is the cash value. Death benefit is somewhat secondary. You want to optimize that cash value. Core benefits are as follows: safe, liquid, tax-free. We've got some more information to the right. What to look for is as follows. Step number one, what it should look like. When you make a payment to the policy in the first year alone, you should see a minimum of 85 to 90% of your payment show up in cash value. It could be more than that depending on the product. The highest we can often get it is right around 95%. That's with a high early cash value product, but with traditional products, between 85 and 90%. I pay in $10,000, I should see between $8,500 to $9,000 in the first year. My break-even point or positive cash value should fall between years 3 and 5. For example, if I'm paying in $10,000 per year, by year 5, I would have paid in $50,000. I should have $50,000 or greater by that point in time. And then number 3, I love this point. Flexibility. How do I take a whole life insurance policy, which traditionally is a very boring product? I pay a premium every month or every year. I have life insurance, cash eventually builds up, and turn it into a flexible savings asset where I can bounce my payments up and down over time. For example, if I want the ability to pay in $100,000 per year, but I don't want to get a bill for that, did you know you could commit to $10,000 per year and at discretion add up to $100,000 per year? Whether you hit the 100K or not is completely up to you. Additional payments just accelerate cash value growth. Huge advantage, lot of lack of awareness on that area as well. It's so interesting when you see how that works. So number 1, that's what it should look like. Those 3 points right there. High cash up front, breaking even very early, and then flexibility in the event life happens, you can bounce payments up and down. And then number 2, company selection. How do I choose the right company? There are a lot of insurance companies out there. we have found that the 4 major mutual companies have consistently delivered among the strongest cash values to policyholders. Those companies being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Aside from what projections and illustrations display, we've seen consistency with those 4 carriers. So, a lot of information here, making sure we get it right. Let's see what it should actually look like, because we talked about it here. Let's look at some numbers. Here is an example of a policy on a high net worth individual putting in $1 million right off the bat. We see rich cash values right off the bat, north of 95%. Option 1 pays in $1 million, has about 97%, breaks even between years 2 and 3. This option over here breaks even between years 3 and 4. We see the net internal rates of return in black. This one tops out a little over 5%. Now, he's paying in $1 million here, age 45 male. We may look at this and say, okay, I don't have $1 million to pay in. Here's an example of how corporations use these products. This is a traditional policy anyone can obtain. Corporation funding a policy on one of their executives, age 50 male, $100,000 per year for 7 years, not a penny thereafter, right off the bat. 89% of what he paid in shows up in cash value. What is highlighted in yellow represents his break-even point between years 3 and 4, meaning by year 3, he's paid in a total of $300,000. He's got about $295,000. Immediately, year 1, he's got 89% cash-rich product. By the way, the corporation in this example can commit to a minimum of $10,000 and then add up to $100,000 per year at their discretion. And then over here, we see income eventually coming out with these disbursements, but that's more so demonstrating how corporations use it. And then if I'm looking at a lower amount, this really works with any number, $10,000 per year. This demonstrates the same company, same product, but different ways of setting the product up from what many people see, $10,000 going in, just about nothing in cash value right off the bat. Great example of what not to do, $10,000 in, $1,100 in cash value. Middle example, not that attractive, $10,000 in, 54% right off the bat. But then, again, same company, same product, same out of pocket to you, the consumer, $10,000, about 88% right off the bat. Breaking even, year 5 in this example. So if a policy is constructed properly, like we see in these examples, that's where we see it actually work for the cash value benefit. So I know this was a lot of information. If you have any questions, please feel free to reach out anytime. You can call or email us, and I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.